So this is problem 11-2. It's very similar to 11-1, except the company's not starting from scratch. It already has balances in its accounts, so it gives us the stockholder equity section as of January 1st, 2014, and then we have the 2014 transactions. So part 1 is to journalize the transactions. This will be just like the things we did on 11-1 if you watched that one. If not, then, well, I guess you'll just have to go from there. So February 1st, issue 20,000 shares of common stock for $160,000. Let's see what we know about this. It is $1 stated value, and that's all we know. So if they issue 20,000 shares of common stock and has $1 stated value, then we know that they did something in excess of that. So February 1st, we had cash, which is going to go up by $160,000. And the other one, they had dollars per share, and you had to multiply it out. Here it tells you how much cash they bring in, $160,000. And then we'll have common stock. If it was 20,000 shares and the stock has a $1 stated value per share, then that's going to equal 20,000 shares times $1, or $20,000. And then the last one will be the paid-in capital. In excess of stated value. And I'm just going to put SV for stated value, and I'm going to put CS for common stock as opposed to PS for preferred stock, just to make it a little easier. And that will be the difference, right? If we brought in 160,000 total and 20,000 of it was common stock, then the difference will be the total amount minus the amount that we call common stock. That's the amount that's the paid-in capital in excess of the stated value for the common stock. Just remember the debits and the credits for each transaction have to balance or add up. It will be all right. On November 10th, they purchased 4,000 shares of common stock for the Treasury at a cost of $16,000. So this one we didn't do in 11-1. So if they paid $16,000 for it, Treasury stock's always listed at its cost, and then we pay cash for that. On November 15th, they declare a 9% cash dividend on the preferred stock payable December 15th. So a 9% cash dividend on the preferred stock. So we would look and see what our preferred stock is right now. So preferred stock is $200,000. So if it's a 9% cash dividend on that, remember, a dividend is its own kind of account. It looks a lot like an expense, but it's not, in the sense that it doesn't go on our income statement. So the cash dividend is going to be the amount of preferred stock out there, which is $200,000, times the amount of the dividend, which is 9%. So $18,000 worth of dividends. They don't pay them yet. They will pay them in the future. So it's going to be a dividend payable, which is actually a liability. On December 1st, they declare a 30-cent per share cash dividend to common stockholders of record December 15th. So again, we're going to say cash dividends. And it's, let's see, how many shares are out there? Common stock, $1 stated value, and there's 1 million shares, or $1 million worth. Okay, so we're going to assume then, well, not assume, we just do the math. 1 million shares divided by $1 per share means 1 million shares have been issued. But let's see, We know that we just bought some back into treasury stock, right? There's 8,000 shares here. Then we issued 20,000 on February 1st. Remember, what we have here is the old, the information at the beginning of the year. So this one's a little bit confusing. So to figure out how much cash dividend we're going to pay, or how many shares are out there, we have to do a number of things. We start with the million shares that we get by looking at the common stock here. $1 million worth of $1 stated value is 1 million shares. Then we subtract the $8,000 shares in treasury stock. Then we add the shares that we issued earlier, right here is 20,000. And then we subtract the 4,000 shares that we bought back into treasury stock since all of this was listed. That's the number of shares of common stock that are sitting out there. So if we just solved it like that, it would tell us the number of shares. But now we're going to do a dividend of 30 cents per share. So we're going to take that amount times 30%. I'm sorry, 30 cents per share, not 30%. So that's how we figure out the amount of the dividend. Again, we haven't paid it yet, so it's a dividend payable. So the trick to that is figure out the number of shares of stock that are outstanding and then multiplying that by the dividend rate per share. And then again, just as a review, the way we figured out the number of shares outstanding is we took the January 1st information that there were 1 million shares, and we figured that out because the common stock is worth $1 million at $1 stated value. That'd be 1 million shares at $1 each. That was our starting point. And we subtracted the 8,000 shares that were in treasury stock because we don't pay a dividend on any shares that the company itself is holding as treasury stock. That gave us then the number of shares outstanding at January 1st. Then we added another 20,000 shares that we issued on February 1st, and we subtracted another 4,000 shares bought back into treasury stock, and that gave us the total number of shares we held at the time the dividend was declared on December 1st. Multiplied that by the rate of 30 cents per share, and that's what gave us our dividend. All right, on December 15th, paid the dividend declared on November 15th. Okay, that's easy enough. So on November 15th, so our dividend payable will now go down by the amount, 18,000. And our cash, since it was a cash dividend, will go down by 18,000. And then on December 31st, paid the dividend declared on November 15th. So again, our dividend payable will go down or be debited 302,400. And our cash will go down by 302,400. And then let's see, the market price of the common stock on this date was $5 per share. Paid the dividend declared on December 1st. So what they did there is they gave us a bunch of obfuscating or confusing information, but none of that mattered because the dividend had already been declared. All we were doing is paying it out in cash. It may come back if they want us to do something later that we'll need that information, but for that part, we didn't need it. All right, number 2 is enter the beginning balances of the accounts and post the journal entries to the stockholder equity accounts. Use T accounts. So this is just like what we did in problem 11.1, except now we have beginning balances on these accounts. So we'll start by setting up our T accounts. In fact, I'm going to pause it so you don't have to watch me go through the process of setting them up. All right, I've got them all set up now, so now I'll go ahead and put in the beginning balances, the preferred stock account. And this information, again, was just given to us in the problem. So preferred stock account had a balance of $200,000. Common stock had a balance of $1 million. The paid-in capital in excess of par value on the preferred stock had a balance of $16,000. And the paid-in capital in excess of stated value on the common stock had a par value, or had a value, a beginning value of $1,400,000. Retained earnings had a balance of $1,716,000, and the treasury stock had a balance of $20,000. All right, so now we have to go through and look at these transactions that we posted and add them. So we did common stock, debit of $20,000, and paid-in capital in excess of stated value on common stock, $140,000. Treasury stock had a debit of $16,000. Ooh, actually, this beginning balance on treasury stock should be over here, right? Because treasury stock is a contra equity account. So there's another debit to treasury stock. Our dividends, I don't think, we're not required to track those here, just the things that are on our balance sheet. And so that should be it. So our new balances, I'm not even going to bother adding anything up if I didn't change it. Our balance on preferred stock should stay $200,000. Paid-in capital in excess of par value on the preferred stock stays $16,000. Our new balance on our common stock should be, let's see, did I put enough zeros there? It's hard to tell without the commas, isn't it? Yeah, $1,020,000. And $1,540,000. Retained earnings stays oh wait, that's not true. That's going to trick us. Remember where I said there was that information we probably didn't need? Or we didn't need at the time? Well, here's where it's going to come in. So it says it tells us the net income for the year was $408,000. So if you remember, the way we calculate retained earnings is we have our beginning retained earnings, which were, let's see, $1,716,000. Then we add net income, which it tells us net income for the year was $408,000. We deduct dividends because they get paid out of the retained earnings. So the dividends right here, $18,000. And $302,400. And this will give us the new or ending retained earnings. So beginning plus net income minus dividends. So our new retained earnings will be $1,803,600. The way this would look over here is we would add the $408,000 from the net income, and we would subtract the $320,400 of dividends that come right here, $18,000 and $302,000, so $320,400. And our new balance would be $1,803,600. And then our treasury stock of 36,000. So there's the balances on all of our accounts. All right, 3 says prepare the stockholders equity section of the balance sheet. So this will be just like we did in number 1. So again, we'll go ahead and make that bigger so we can see it. And I'll just do it right here. This is the Warden Corporation. This is a partial balance sheet. We don't have the assets or the liabilities, right? And this will be the stockholders' equity. And we're doing the paid-in capital section. Actually, we're doing both because we're doing retained earnings as well. Capital stock. We have the 9% preferred stock. Sometimes you can put a lot of other information. I'm just going to put that for now for simplicity's sake. So we can come up here and look at our preferred stock and see that it has a $200,000 balance. We also have our common stock. No par. That had a balance of $1,020,000. So that'll be our total capital stock. Then we'll have our additional paid-in capital. So we'll have our paid-in capital in excess of par value on the preferred stock. That had a balance of $16,000. And then our paid-in capital in excess of stated value on the common stock. That had a balance of $1,540,000. So our total paid-in capital I'll do it out here, is the capital stock plus the additional paid-in capital. Then we'll have our retained earnings. Remember, our retained earnings now has a balance of $1,803,600. Don't know why that's not dollars. This will be our total paid-in capital and retained earnings. Then we'll do that's treasury stock. Treasury stock has a balance of $36,000. That would give us our total stockholders' equity. And there you go. That was part 3. Part 4 is calculate the payout ratio, the earnings per share, and the return on common stockholders' equity. And use the common shares outstanding to determine the average shares outstanding. All right. So I'll just do it right here. Payout ratio. What else did they want? Earnings per share. And return and was that it? Okay. All right. So first of all, to find the payout ratio, all we have to do is take our payout, our dividends on our common shares, which would be right here, the 302,400, and divide that by the net income. That's the payout ratio. So it's kind of like saying, of the net income or of the profit the company has made, how much of it, what percentage of it was paid out as a dividend to the common shareholders. Oops. We'll express this one as a percentage and see that it was 74.1%. All right. To find our earnings per share, we're going to have to take our net income minus our preferred dividends, because it's, whoops, something didn't like that. So our net income minus our preferred dividend, and then we divide that by the average stockholders' equity, which is the stockholders' equity at the beginning of the period, which takes a little bit of figuring out. Let's see. All right, so our stockholders' equity at the beginning of the period will be our $1 million in common stock, plus our $1.4 million in excess in paid-in capital on the common stock, plus our retained earnings. So that's the common stockholders' equity, and then minus the $20,000 in treasury stock. So we don't want to add in the preferred stock. Preferred stock is its own sort of animal, and so usually when we do these, we just deal with common stock. So at the beginning of the period, we had a common stockholders' equity of $1 million plus the additional paid-in capital of $1.4 million plus the retained earnings less the treasury stock, and that comes out to $4,096,000. We want to find our average, so that's the beginning. So now we have to figure out our common stockholders' equity at the end of the period, which we can do by looking right here and seeing that we have $1,020,000 plus $1,540,000 plus retained earnings of $1,803,600 minus treasury stock of $36,000. And that gives us $4,327,000 600. And divide that by 2. So that's how you find earnings per share. Want a review of that real fast? We take our net income, that's our earnings, and we subtract out any dividends paid to preferred stockholders so that we have our net income free of that. So that's the net income of $408,000 minus the preferred dividends of $18,000. Then we divide that by the average common stockholders' equity, which is the common stockholders' equity at the beginning of the period, which we found by adding up the value of the common stock, the additional paid-in capital on the common stock, and the retained earnings, and subtracting the treasury stock. And then we did the same at the end of the period, and then divide that by 2 to give us the average. And again, we need to express that as a percentage. And something's not right. That number is not right. Let me check my math. Well, that should be right. Let me pause it and figure out what I'm doing wrong. I think perhaps if we put another set of parentheses around this, it'll tell Excel to do the order of operations so that division by 2 happens before everything else. Let's see if that gives us, yes, that's what it should be, 9.3%. Finally, the return on common, oh no, that was the return. Did I skip one? I did. I probably just confused the heck out of you. So that was the return on common stockholders' equity. So I apologize. Hopefully I didn't mess you up too badly. I just skipping ahead. So earnings per share, we do the same thing on the top. We find the net income minus the preferred dividends. Oh, we have the same problem here. The net income minus the preferred dividends. But instead, we have to figure out the number of shares that are outstanding, and that's the average number of shares. So again, we have to kind of look and say what were the number of shares at the beginning of the period, which we know we had 1 million shares because it was $1 stated value, and there were $1 million worth, so we had 1 million shares, less treasury stock. So we had 980,000 shares. I'm sorry, it's only 8,000. So 1 million minus 8,000 is 992,000 shares at the beginning of the period. And then at the end of the period, we can look at our numbers here, except they won't tell us exactly, so we have to think about it. We had 1 million shares, we issued 20,000 more, and then we had 8,000 shares of treasury stock, and we bought back 4,000 more. So it's going to be 1,020,000 shares minus 12,000, or 1,008,000 shares at the end of the period. Divide that by 2 to get the average number of shares. Let's see. And we will add one more set of parentheses. And hopefully that will give us our earnings per share. Again, we don't want those as dollars. Well, we do, but we need some decimals. 39 cents per share. And that should do this problem. Hope I didn't get you really confused by accidentally skipping and doing them out of order. As always, let me know if I can help you in additional ways.